Stop. Don't scroll. Look at your phone's clock right now. At approximately 6:30 p.m. Eastern Time tonight, Saturday, February 14th, 2026, Valentine's Day, payment processing systems across major U.S. metropolitan areas experienced what the mainstream financial media is calling a brief technical outage. Brief technical outage. 3 words designed to make you go back to sleep. 3 words engineered to prevent you from asking the one question that matters. If it was just a technical glitch, why did it happen simultaneously across multiple unrelated payment networks at the exact moment when consumer transaction volume peaks? I'm going to tell you what actually happened tonight. Not the sanitized version you'll hear on CNBC, not the corporate press release from Visa, not the damage control from the Federal Reserve. The word they're avoiding is liquidity. And if you don't understand what happened between 6:30 and 6:44 p.m. tonight, you will not survive what's coming on Monday. My name is John A.G. I'm not a YouTuber. I'm not an influencer. I am not selling courses. I'm a crisis intelligence analyst who spent 15 years working inside the settlement infrastructure of the financial system. I have seen the overnight interbank lending reports that never make it to public disclosure. I have watched the real-time liquidity stress indicators that the Federal Reserve monitors when markets close and settlement begins. And I have sources still embedded inside that system who tonight, at 7:03 p.m., sent me confirmation of what I've been warning you about for 3 straight videos. The liquidity is gone. The overnight lending market that keeps the entire banking system operational just froze. For 14 minutes, the settlement layer experienced a hard reset. And the only reason your card worked again at 6:44 p.m. is because they emergency injected liquidity through a channel that was never designed to be used outside of systemic collapse scenarios. This was not a glitch. This was a test, a controlled detonation to measure exactly how the system fails when they pull the plug. And what they learn tonight will determine what they do. Monday morning, when the banking holiday they have been planning for 6 months gets activated for real. I warned you 3 videos ago the COMEX registered silver inventory had fallen below 27 million ounces. I showed you the $4 billion spoofing order that dumped the paper price while physical premiums exploded to 28%. I told you the Shanghai gold premium hitting $140 over New York spot was proof the East knows the West as vaults are empty. I said Republic First National freezing wire transfers over $10,000 for maintenance was the first domino. Some of you listened. Most didn't. Most thought the system was too big to fail. Tonight, at 6:30 p.m., while you were trying to pay for a Valentine's Day dinner, the system showed you its hand. It showed you what happens when the liquidity runs out. It showed you what a 14-minute preview of a banking holiday looks like. And if you were in New York, Los Angeles, Chicago, Houston, Phoenix, Philadelphia, San Antonio, or any of the other 37 metropolitan areas where payment processing simultaneously failed tonight, you got a free education worth more than any financial degree. You learned that your money is not actually yours. You learned that your access to that money depends entirely on a network of overnight lending between banks you've never heard of. You learned that when that network freezes, even for 14 minutes, you become financially paralyzed regardless of how much money your bank statement says you have. Let me explain what happened. At 6:30 p.m., the Federal Reserve's FedWire Fund Service experienced what insiders call a liquidity gap event. When Bank A needs to send money to Bank B to settle transactions, they move digital ledger entries through FedWire. Those transfers require Bank A to have actual reserves on deposit at the Federal Reserve. Real reserves, not paper promises. Under normal conditions, if Bank A is low on reserves, they borrow from Bank B through the overnight interbank lending market. This happens automatically. It's been happening every night for decades. The interest rate typically hovers between 4 and 5%. Banks lend to each other because they trust repayment tomorrow morning. This trust is the foundation of the system. This trust is what allows your credit card to work 2,000 miles from your bank. Tonight, that trust failed. Multiple banks attempted to borrow reserves to settle Valentine's Day volume, and the other banks said no, not at 4%, not at 5%, not at any rate. The overnight lending market froze. The last time this happened was September 2019, when rates spiked from 2% to 10%, and the Fed emergency injected $75 billion, but that was during market hours. Tonight was Saturday at 6:30 p.m., when the Fed's intervention desk is minimally staffed. For 14 minutes, your payment sat in a digital queue, waiting for reserve confirmation. For 14 minutes, the chain from your card swipe to the restaurant's account was frozen because a bank could not prove liquidity. At 6:44 p.m., payments resumed. Not because liquidity returned, but because someone inside the Federal Reserve manually authorized an emergency injection through a facility, my sources confirm, is only for declared financial emergencies. The Federal Reserve just treated a Saturday night payment delay as a crisis severe enough to justify tools created for 2008 level scenarios. They didn't announce it. They quietly injected liquidity, payments resumed, and by 7:00 p.m. most people had forgotten. But the banks didn't forget. They now know exactly what breaks when liquidity runs out, how long the system can operate in degraded mode, and which emergency tools they need before activating the kill switch for real. This wasn't a glitch. This was a rehearsal. They chose Valentine's Day deliberately. They chose 6:30 p.m. deliberately. They chose Saturday night deliberately. Valentine's Day is the second highest consumer spending day after Christmas. 6:30 p.m. is peak restaurant payment time. Saturday night is when banks are minimally staffed. They needed real-world data on panic speed, alternative payment adoption, social media amplification, and liquidity injection outside market hours. What they learned tonight determines Monday. Let me show you the 6-week pattern this test confirmed. January 2nd, China restricted silver exports, reclassifying it as strategic material. January 7th, JP Morgan delivered 8.1 million ounces from COMEX, 99% of all deliveries that day. January 15th, the Fed reduced bank reserve requirements from 10% to 3%. January 22nd, China suspended its only silver futures fund due to systemic risk. January 30th, silver crashed from $121 to $95, while physical premiums hit 60% over spot in Dubai and Tokyo. February 4th, VP Vance convened 50 nations for a critical mineral summit 4 days after the biggest silver crash in 46 years. February 5th, repo rates spiked from 4.5% to 9.2% as 14 institutions accessed the Fed's emergency facility. 6 weeks. 11 events. Everyone is a stress indicator. They're accelerating. Time between events is compressing. Severity is escalating. And tonight's test says they're ready. Monday is President's Day. Markets closed, banks closed, minimal staffing. Perfect day to activate temporary freezes on large withdrawals, implement capital controls or force conversion to central bank digital currency. Historical precedent is clear. March 1933, Franklin Roosevelt declares a 4-day banking holiday to stabilize the system. Banks close nationwide. When they reopen 5 days later, gold ownership is illegal, and citizens are required to surrender their gold to the government at $20.67 per ounce, under threat of 10 years imprisonment and $10,000 fines. 15 months later, the government revalues gold to $35 per ounce, a 70% confiscation of purchasing power from every American who complied. August 1971, Richard Nixon closes the gold window on a Sunday night, ending dollar convertibility to gold so markets cannot react. By the time trading resumes Monday morning, the entire Bretton Woods monetary system has been restructured without congressional debate or public input. March 2013, Cyprus implements capital controls overnight, freezing deposits over $100,000 and confiscating between 6.75% and 9.9% to recapitalize failing banks. Depositors wake up to find their money gone, converted to worthless bank equity, while government officials assured them deposits were safe just 48 hours earlier. Everyone happened outside market hours, over weekends or holidays when people couldn't react. Everyone was preceded by escalating stress, official reassurances, then sudden emergency action. Tonight, you watch the modern playbook execute in real time. Tonight was the test to see if a 14-minute freeze triggers mass panic. It passed. Social media mentions peaked at 6:37 p.m., dropped 80% by 7:15 p.m. Mainstream media hasn't covered it. They now know they can freeze the system for at least 14 minutes with minimal awareness. The question is, what they do Monday with an entire 3-day weekend while markets are closed. Physical silver is trading at 71.50 on paper, while Eagles are 92. That's 28% premium. COMEX has 32 million ounces of silver available for delivery. Open interest represents claims on 760 million ounces. That's 24 paper claims for every single real ounce sitting in the vault. Think about what that means. If even 10% of paper contract holders demand physical delivery instead of cash settlement, we're talking about 76 million ounces of demand against 32 million ounces of supply. The math doesn't work. The exchange has 3 options when this ratio breaks. Find 44 million ounces of metal they don't have and never will have, default on contracts and admit the paper price was fiction, or implement forced cash settlement. Cash settlement means they pay you dollars instead of metal, at whatever price they decide is fair market value. But if you demanded metal because you understood dollars are becoming worthless, getting paid and devaluing dollars instead of scarce physical metal isn't settlement, it's legalized theft disguised as emergency market stabilization. Tonight, for 14 minutes, you couldn't access your money. Monday, that 14 minutes could become 14 hours, or 14 days, or permanent restrictions with weekly withdrawal limits, mandatory transaction justifications, and forced conversion to digital currency that tracks every purchase you make and can be frozen remotely if an algorithm flags your spending patterns as suspicious. This is not science fiction. This is not conspiracy theory. This infrastructure already exists and is being tested in real time. Central bank digital currencies are operational in multiple countries. The Federal Reserve has a working FedNow prototype that processes instant payments and creates a permanent ledger of every transaction. China's digital yuan is fully deployed, tracking 260 million users and allowing government officials to freeze accounts, set expiration dates on money to force spending, and restrict purchases based on social credit scores. Europe's digital euro is in advanced trials across 5 member states. The technical capability to implement this system in the United States exists right now. The only barriers preventing immediate rollout are public resistance and political will. Tonight gave them both the technical proof of concept and the crisis narrative to overcome those barriers. Tonight gave them the crisis narrative. Payment instability requires modernization. Consumer protection demands secure digital infrastructure. National security necessitates transaction monitoring. The framing is written. The legal framework exists. The test proves they can freeze the current system and restart it with different rules. If you're holding paper silver, paper gold, or any precious metal asset that exists only as a digital entry in someone else's database, you need to understand a fundamental truth that tonight just proved. You do not own that asset. You own a claim on that asset. You own a contractual promise that someone, somewhere, will deliver physical metal to you when you want it. And claims can be restricted, frozen, suspended, or converted to something else entirely without your permission and often without advance notice. Physical metal that you hold directly in your possession has zero counterparty risk. It cannot be frozen by a federal order. It cannot be confiscated without physical force, which requires warrants, due process, and boots on the ground. It cannot be converted to digits in a central bank computer through an overnight regulatory change. It cannot be cash settled by an exchange that ran out of inventory. This is why physical premiums are exploding to historic highs. People who understand systemic risk and have access to institutional intelligence are willing to pay 28% over spot price for Silver Eagles because they know the spot price is a fiction maintained by paper contracts, and the physical metal is the only form of wealth that will survive what's coming. When the paper market breaks, when COMEX defaults or force settles in devaluing dollars, the people holding physical will name their price, and the people holding paper will be left with worthless claims on metal that never existed. If you have deposits above FDIC insurance limits of $250,000, you need to understand that in a bail-in scenario like what happened in Cyprus, those excess deposits can be converted to bank equity to recapitalize failing institutions. This happened in 2013. This is explicitly legal in the United States under Title II of the Dodd-Frank Act. Your deposits above insurance limits are classified as unsecured liabilities on the bank's balance sheet. If the bank fails, you're not a protected customer. You are a creditor in line behind secured bondholders, and creditors get wiped out before shareholders see a penny. The solution is immediate. Spread your deposits across multiple FDIC-insured institutions, keeping each account under the $250,000 limit. Consider credit unions which have separate NCUA insurance. Hold physical cash outside the banking system, not for long-term value storage, but because in a short-term liquidity crisis, when ATMs stop working and payment processors are down, physical currency is the only medium of exchange that functions. Keep enough to cover 2 months of expenses and small bills stored securely outside any financial institution. If you operate a business, depending on daily payment processing, you need backup plans. Alternative payment methods, cash reserves, supplier relationships that handle delayed payments. Because if tonight was the test and Monday is implementation, your business could be frozen regardless of balance sheet health. This is not fear, this is pattern recognition. Every major crisis was preceded by officials saying everything is fine, tests that seemed minor, then sudden shift to emergency measures. Tonight was not a glitch. Tonight was a message. The system is fragile, liquidity is gone, and the ability to freeze your access already exists and has been tested. Monday is 36 hours away. The banks know what's coming. The Fed knows. The insiders who injected liquidity at 6:44 p.m. know. The question is whether you're going to wait for official confirmation or act on the pattern while you can. This is John A.G. I warned you about COMEX drain. I warned you about Shanghai premium. I warned you about Republic First freezing wires. Tonight, while you tried to buy dinner, I watched the overnight lending market freeze in real time. Monday morning, you'll either be positioned for what's next or scrambling to understand why your account access is restricted for your protection. The choice is yours. The window's closing. The system just showed you what it's capable of when they decide your money is theirs, not yours. If you understand tonight wasn't a glitch, but a controlled test, hit subscribe and turn on notifications. When this activates for real, you won't have time to research. You'll have minutes to act. Share this with one person who deserves to know before Monday morning. Drop a comment if your payment failed between 6:30 and 6:44 p.m. and which city. Let's document this because mainstream media won't. The test is over. The data is collected. Monday is 2 days away. Good luck.